lowest interest rate loan that exists. Look, if you're going to get business financing, you need to have a phenomenal interest rate, because the lower your interest rate, the lower your payments. The lower your payments, the more you can borrow, right? So there is a key. There are strategies you need to know to be able to get the lowest interest rate. And a lot of business owners just don't know these. A lot of business owners don't even know what lenders are looking at to be able to determine their risk and therefore calculate the interest rate. But look, it doesn't just stop at interest rate. It also goes and carries over to term, meaning that if you want the lowest payment financing that's out there, then you need two things. You need a longer term, you need a lower interest rate. When you combine those two things, that's what allows you to borrow a lot of money and keep your payments very, very, very small. So let me give you an example of what we're talking about before we dive into these strategies. So the first loan we ever borrowed was 75 grand. Our payment was 9,000 a month. The second loan was 325,000. Our payment was 4,600 a month. Our payment was half as much to get an extra $250,000 in financing. How is that possible? Because we used these strategies on the second loan to get the lowest interest rate and the longest term. And this is what's possible for you. And it's exactly what we're about to dive into right now. So if you're just coming in, give me a shout out. Give me your company name, and I'm going to give you a shout out right here on the live stream. So if you want to secure the lowest rate business loan, the very first thing you need to do is be building your business credit score. So if we look at business credit profiles, a profile itself, the business credit profile will help you get more approvals. It'll help you stop denials. But if we look deeper into the profile and we look at the specifics like the score itself, the score is directly linked to the interest rate you'll pay, the terms you are given. So if you want to get a lower interest rate, if you want to get significantly better terms, then the key to that is for you to actually have good business credit scores. So how do we do that? How do we get good business credit scores to secure the lowest interest rate loan? Well, there's two things. First, we need to build our business credit. We need to get credit with credit issuers that report that credit to the business credit reporting agencies. Dun & Bradstreet, Equifax, Experian. When we do this, then that gives us the ability to actually have more accounts reporting to the business credit reporting agencies. Step two, we need to pay those accounts on time or early. Look, there's a lot of things that calculate into your business credit score. As a matter of fact, you can go to youtube.com/credit suite or just look at Credit Suite on YouTube, and we've got detailed breakdowns of what you need to know about your business credit scores. DNB, Equifax, Experian, all of them, FICO. But the most important thing, to take all that training out and just say one thing you can do: pay your bills on time or early. Your main business credit scores are based on that factor and that factor alone. Your secondary business credit scores are based mainly on that factor and other factors as well. So if there's one thing you could do, you want to get the accounts that report and pay those as agreed. I guess that's two things. So first, get the accounts that report to the reporting agencies, and two, pay them on time or early. That one thing of paying them on time or early is what is going to give you good scores. And you want to add a lot of accounts to your business credit reports, because even if you go bad or late on one, well, then you've got other positive ones to compensate. Those scores directly link to how you pay. And if you do this one thing, you have good scores. And when you have good scores, you get low interest rates. The same as a mortgage. If I'm going to apply for a consumer mortgage, like I want to go buy a personal home for myself, right? Those scores are directly linked to credit scores. I own a mortgage company. We have rate sheets. We have matrices. The matrix says, here's the credit score, here's the rate. Here's the credit score, here's the rate. And we can go down these matrices and see the exact credit score and determine the rate for the borrower. Business loans are very similar. Like your score is looked at on a matrix and your score is determining your rate. So if you want to get low interest rates on loans, credit lines, and credit cards, you've got to get those business credit scores up there. That's the number one thing you can do to secure low interest rate loans and credit lines. And by the way, if you're just coming in, give me a shout out. Tell me your company name, and I'm going to give you a shout out here right on the stream. Number two strategy for getting the lowest interest rate business loans is have some kind of asset that you can serve up as collateral. The best lowest interest rate loans that exist all have collateral, almost all of them. Like, so let's look at two examples. Cash flow financing, right? First loan we ever got, cash flow financing, $75,000. Our payment was $9,000 a month. The term was short, like 2 or 3 years. The interest rate was high. Okay, this is common if you don't have collateral. Second loan we got was an SBA loan. We had collateral. That SBA gave us a way longer term, like 10 times longer term than the first loan did, and our rate was way cheaper. That's what allowed us to borrow $250,000 more in financing and cut our payment in half, right? So it all comes down to having collateral. What works as collateral? Stocks, bonds, 401ks, IRA, inventory, equipment that you actually own. So a buddy of mine contacted me this week. He said, hey man, I need financing. And in doing my due diligence research with him, I found out he has a bunch of equipment he owns free and clear. Well, we're going to get him very low interest rate financing using that as collateral to be able to get him a loan. If he would have went with what he asked me for, which was cash flow financing, his rate would have been 10 times higher than if he did go with the collateral-based financing. So stocks, bonds, 401ks, IRAs, equipment, inventory, real estate, cryptocurrency. Yes, there are places out there like Compound and like Airy that actually offer cryptocurrency loans where you can keep the crypto invested where it is and leverage against that and still get a business loan against cryptocurrency. Okay, and one of the most popular, not the most popular type of collateral used for SBA loans is account receivables, where you let your customers pay you on terms. And just by doing that one thing, that one thing alone will automatically give you what you need to be able to give you low interest rates. So remember, having some kind of collateral will really offset your risk. Going with asset or collateral-based lenders, going with term loans and SBA loans where they require collateral, that will open up interest rates of 8% or less, oftentimes 5% or lower. And remember, account receivable financing, you can't lose with that. You let your customers pay you over time, you get all your money right away, you attract more customers, and you build an asset that helps you borrow against it to get all kinds of low interest rate financing. So if you have any kind of asset, you can pledge as collateral, do so, and that will help you secure the lowest interest rates. The next thing, shop around and leverage one source against another. I got approved for a Bank of America credit line once, and they told me the approval amount and the rate. And I said, I'm not interested. No, thanks. I appreciate you taking the time. The underwriter was shocked that I would turn it down. And she said, why are you turning it down? I said, because I already have another credit line with Regions that's more money and a better term. She said, what's the interest rate? What's the amount they gave you? I told her, and she automatically copied exactly what they did. She gave me the same rate and the same approval amount. Matter of fact, her approval amount was a little higher because she wanted to be the highest limit account we have, so we would use them. Just by telling her, I actually have another offer on the table with a higher approval amount and a better interest rate, I'm going to go with them. They matched that, even beat what I was given. So this is the benefit of shopping around. If you're trying to get cash flow financing, don't just take what the lender gives you. Go check with 2 or 3 lenders, especially if it doesn't result in a hard inquiry on your credit report. Find the best terms, and then determine which lender you like. If you liked one of the other 2 that had higher terms, then go back to that lender and say, hey, look, I would love to move forward with you, but I got this other approval. It's better than what you've got. Like, can you match or beat this approval? 8, 9 out of 10 times, they will match or beat whatever you were given. So if you're going to get a loan, find 2 or 3 lenders that do that kind of product, apply with all of them, and leverage one against the other. What this will oftentimes do is 2 things. It'll give you a lower interest rate, and it'll give you a higher approval amount, because the lender doesn't want to match what you were given. They want to beat it. So they'll typically come in at a lower interest rate and a higher approval amount from the one you're comparing them to. So just by shopping around, you get more money and lower interest rates as well. The next strategy to get the lowest interest rate is build a relationship with lenders. Look, I talk a lot about funding stacking, and I need to do that more on my live streams than I do on my other content on our social channels. But with funding stacking, you are literally going out, building relationships with 10 different lenders, opening accounts, running money through those accounts, letting them season, and mass applying for funding all at one time. This strategy can result in 3, 4, 500,000 in funding, and 6 months later, you can do it again. And 6 months later, you do it again and again and again. It's insane amounts of money. But this strategy works because you're building a relationship with a lender. You're going in, you're opening up an actual bank account. You got some money coming in, you got some money coming out. You know the business banker that's there. And when you're doing these things, the bank sees you have a relationship and they're exponentially more probable to give you an actual approval. They'll approve you for loans, they'll approve you for credit lines, they'll approve you for credit cards, even as a newer business, because you have a relationship with them. Banking relationships matter a lot because they don't care about you have a relationship with the banker, like you go hang out to barbecues. That's not what I'm saying. What I'm saying is that if I go to Bank of America and I open an account and I've got money coming in and out of that account for 3 months, Bank of America knows that I will be their client. And now they want to make me happy. If I go open an account with Bank of America and build a relationship with the banker and I just put money in and never do anything, it doesn't mean anything. Bank of America knows I'm not doing anything with that account. It's the same with credit cards. You have a better chance of getting approved for a higher limit credit card if they see that you're actually using the credit card. They want you to use it. That's how they make money. So you want to build a relationship by building a relationship with the bankers. And then you also want to be building an actual account. One, multiple accounts, checking, savings, money market account, and have some money flowing through there. When you do this, it exponentially increases the probability that you will actually get approved for financing with that bank. As a matter of fact, with funding stacking, we spread that out. We start building relationships with all banks. We build them with national banks. We build them with regional banks. We build them with credit unions, and that helps us get maximum funding. So build a relationship with the bank. Build a relationship with a broker that has those relationships with banks. Look, we are what's called a super broker, okay? We do way more funding than any normal loan broker that's out there. It might take 50 of them to do the volume we do. So the difference is that we have a really good relationship with the banks that we place deals with. And so when I come in and ask for a favor or an exception, we get that favor or exception. And I can't tell you how many times somebody comes to us and gets denied with a bank like On Deck, and then we take the application, we submit it to On Deck, and we get it approved. And the client goes, how did you do that? I applied, got denied. I come to you, or applied through a broker, got denied, came to you, got approved. The difference is we have a relationship with the bank. They want to make us happy because we send them so much business. So have a relationship with the banks you're applying with, or the broker you're using to place the deals. Make sure they have relationships. Do they fund a lot of business? Are they a good size? Are they what we call a super broker? If they are, they've already built those relationships for you, and you can work with them and get the benefit of their relationships. Whether you're building the relationship direct or whether you're doing it through a broker that has them, you want to make sure that you come in and you're working with a bank to have the relationship, or you also want to work with brokers that have those relationships already established. And the final point for strategies to secure the lowest interest rate: ask, negotiate. Okay, I was taught this. I teach my kids this. You never know unless you're going to ask. I'll tell you something. This is kind of a crazy story, but I remember this from high school. I went through Dairy Queen, and I remembered this whole you never know unless you're going to ask thing. So I went through Dairy Queen, and I asked them for like an extra blizzard, and they ended up giving me 2 extra blizzards. Now that means nothing to me as an adult. I love blizzards, but I don't because they're not healthy for me. But at that time, it was like, oh my gosh, I cannot believe I just got 2 extra blizzards just by asking. I teach my kids this lesson. It's one of the most important lessons that I teach them. You never know unless you're going to ask. So always ask. And my daughter is an ace at asking, and it is freaking astonishing what she ends up coming back with. No matter where we are, we're on vacation, we're on a cruise, we're wherever, she shows up with all this valuable stuff. I'm like, how did you get that? She's like, I went to this person, I talked to them, and I asked them. I was like, are you kidding? And what they do? She goes, they gave me this, they did this, they did this. She has learned one of the most valuable lessons that you should have learned if you haven't already. You never know unless you're going to ask. So negotiate. If you get terms that you don't like, ask the lender, what can I do to get a longer term? What can I do to get a lower interest rate? Like, what do I need to do? Because this is more than I wanted to pay. And oftentimes they'll come back and say, what rate did you want? What approval amount did you want? Okay, so these things alone will get you higher approval amounts, longer terms, and lower interest rates just because you're actually asking. So those are the most effective things you could do to secure the lowest interest rate. Number 1, build that business credit score. Pay your bills on time or early. That directly ties in to the interest rate you're going to get. Number 2, get some kind of collateral, stocks, bonds, 401ks, IRAs, equipment, inventory, account receivables, and either get financing that's just based on that asset called asset-based lending, or use that as collateral to get another kind of loan, term loan, SBA loan. That will get you low interest rates. Number 3, shop around. Come in with 2 or 3 approvals, and if you like one of the other lenders but they weren't the cheapest, go to that lender and say, this lender gave me better terms. That lender will often beat their approval. They'll give you a higher amount, they'll give you a longer term, they'll give you a lower interest rate just because you're comparing them to somebody else and they want the relationship. Number 4, build relationships with lenders. Go in, have depository accounts with these banks. Deposit money, withdraw money, use the banks you're going to apply with, and also build a relationship with a super broker like Credit Suite or somebody else that has relationships with those banks, because super brokers, we will get more done than you or a regular broker. So go to somebody like a super broker that already has the relationships built with those banks and leverage that in order for you to actually be able to get more approvals by going through that loan broker to get approved. And the last thing, you never know unless you're going to ask, so negotiate terms. When you get the approval, ask if they can give you a higher approval amount. Ask if they can give you a lower interest rate. Ask if they can give you a better term. I would say 7 to 8 out of 10 times I try this, it works. It's astonishing. I had American Express double my credit card limit, one of the first Amex cards I applied with, just because I asked them. They gave me an approval. I called them. I said, this isn't what I was looking for. I was looking for something higher. I have higher approvals elsewhere. They said, how much do you want? I said, this is how much. They put the application in. I was approved. They gave me an approval. They doubled the approval amount just because I asked. I teach our clients every 6 months to solicit your credit card company and ask them for an increase if they don't do a hard inquiry on your credit. And 7 out of 10 times, it works. Discover lets you do this every month. Every month, I can solicit Discover to have my limit increase. And a soft pull, it's not even a hard pull. So you never know unless you're going to ask. Negotiate those terms once you actually get the approval. If you've done these things, then you are well on your way to getting the best terms and the most amount of money for your business. Don't forget, at Credit Suite, we help business owners improve your fundability, build business credit, and get financing. So if we can help you along the way, please let us know. And if you got value from this training, like and subscribe. Keep your eye out for our next training. We talk about more cool ways to get the money you need to start and grow your business. And if you missed any part of this training, go back on the platform you're watching, whether it be Facebook or LinkedIn or YouTube, and you can watch it in its entirety. Thanks for tuning in. I'll see you next week where we talk about more cool ways to get the money you need.